go through a few housekeeping rules. Before we begin, I would like to familiarize you with the toolbox on the right-hand side of your screens. Just to let you know, everyone will be on mute during the course of the webinar, but if you do have a question, please type it into the little bracket on your toolbox in the please type your question here section to send this to me, and I will take it up during our Q&A session at the end. I'd just like to introduce our expert speaker today. Ran Chakrabarti is a dual qualified lawyer in England and Wales and India, and is a graduate of King's College London and the London School of Economics. Ran spent the first 6 years of his legal career in London and Singapore with finance and projects practices at Ashurst and White & Case, advising multinational corporations and global financial institutions on a range of complex cross-border transactions. He moved to India in 2007 to work with Amarchand and Mangaldas before establishing his own niche practice, advising foreign companies and financial institutions on their inbound India work and Indian companies on their outbound joint ventures and acquisitions. So as you can see, he's got a wealth of knowledge both on inbound India and outbound work. So without further ado, I will pass it on to you, Ran, to take forward your presentation. Thank you.
Natoya, thank you very much for that overly kind introduction. And let me first start by saying that I'm very much delighted to be here this morning, and I'm delighted to be presenting to you on this topic. If we could move to the next slide, please, Natoya. Thank you. If we could move to... Thank you very much. During this webinar, what I'd like to touch upon are really the following key issues which I think you should be keeping in mind in context of setting up your Indian operations. Firstly, I'm going to say a few words about the relevant legislation and the sort of legal landscape that you will have to deal with in India. I will then be going on to say a few words about investments into India in the context of India's foreign direct investment regime, which essentially governs the investment of equity within India. Having done that, I'm going to say a few words about different entry options which foreign entities would consider in context of doing business in India. And this very much depends upon the stage that your business has reached in relation to executing work and selling or manufacturing in India. I will be talking about unincorporated entities which you may wish to use to establish a foothold into the market. And I will also be talking about incorporated entities which will allow you to execute your projects and your business plans in India. Finally, I will say a few words about structuring your investment in India through the mode of a joint venture, which is perhaps the most common way of setting up your business here. And then I'd also like to say a few words in closing about modes of acquisition, about what kind of strategies you can use to establish a foothold within India and the market here. Thank you very much. Natoya, if we could move to the next slide, please. Thank you. Legislation in India is obviously very expansive. In the context of considering your entry into India, there are indeed at least several pieces of legislation which you must take into account. The first is obviously the Companies Act. We have a new Companies Act which was pushed through Parliament in 2013 and is broadly very similar to English company law in many respects. The Companies Act, obviously, as you would anticipate, really governs the issues of share capital on the one hand, and also the management and governance of companies on the other. There is a great deal of overlap between Indian company law and English company law in general. Secondly, you will also need to take into account the Foreign Exchange Management Act, And essentially, if I can distill the issue here, India historically has had a closed economy in terms of the flow of capital, both inwards into India and outwards from India to overseas destinations. This is obviously a legacy of the economic system that India adopted post-independence, and has since been liberalized gradually from 1999 onwards as the economy has become more and more open and liberalized and integrated into the context of the global economy. To the extent that your operations involve either the acquisition of a listed company or listing in India, very much as in other jurisdictions, there are rules and regulations which govern the activities of listed companies and also the acquisitions of shares in listed companies. This is essentially governed by the Securities and Exchange Board of India, otherwise known as SEBI. The other two key issues you need to think about in the context of legislation are the Competition Act, to the extent that your entry into India or your operations in India involve an acquisition, firstly, or secondly, to the extent that they involve the supply or provision of goods and services with entities and in the context of the pricing of those goods and services. To a certain extent, Indian competition law very much mirrors the principles that you would find under the UK Competition Act, under European Union competition law in general. Finally, there are other pieces of legislation which will obviously depend upon the sector of your investment and your operations. That may be mining related. There are mining regulations if you are involved with mining. Obviously, if you're in pharmaceuticals, there are regulations which would be applicable to those particular operations. On that note, thank you, Latoya. If we could move forward to the next slide, please. Thank you. In terms of investing into India and setting up your foothold here, you first need to consider the nature of your business and consider whether foreign direct investment in that particular sector is permitted in India. The easiest way to determine that, firstly, is to look at the negative list. If we look at the prohibitive sectors of the economy, they are becoming smaller and smaller, which is obviously very good news for foreign investment in general. But as of 2016, those few sectors which are essentially off limits to foreign investment include things like the lottery, gambling, chit funds, something what we call in India nidhi companies, which are essentially companies that borrow and lend money between members. Also of note is that the tobacco industry is essentially off-market for foreign investment. And so too at the moment is atomic energy and things like the mining of uranium and things like thorium. Having identified the prohibited sectors, looking at the permitted investment routes, the government of India categorizes FDI through either the automatic route or the government approval route. The automatic route, which is becoming more and more common amongst particular sectors, is essentially, a very good news for foreign investors in general, because it requires limited notification or consent at all from government of India agencies in relation to setting up your business and running it. The government route obviously requires a prior approval. The government of India, in relation to its foreign investment policy, has two particular entities called the Foreign Investment Promotion Board and the Department of Industrial Policy and Promotion. These two institutions are essentially involved with the green lighting of FDI into sectors which require consent. Now, in relation to caps on FDI, they really do vary depending on the sector. Most sectors now permit a degree of foreign investment ranging from 26 to 100%. What I'd like to do is just very quickly run through the sectors of the economy where you can have 100% FDI. And those sectors are, in alphabetical order, the advertising industry, agriculture, courier services, drugs and pharmaceuticals, electricity, power, films and studios, hotels and tourism, housing and real estate, construction, print media, mass rapid transport systems, the mining of gold and silver, non-banking financial corporations, oil exploration, petroleum marketing, petroleum product pipelines, petroleum refining in the private sector, pollution control, roads, highways, ports and harbours, tourism, transport infrastructure, the development of integrated townships, special economic zones, railway infrastructure, and also, more importantly, we can have, in terms of retail, we can have foreign direct investment in single brand retailing up to 49% under the automatic route, and potentially up to 100% with the prior consent of the Foreign Investment Promotion Board. The same also applies with telecoms, where up to 49% is automatic, and anything above that, up to 100%, requires FIPB approval. And finally, asset reconstruction companies, again, that has 49% automatic FDI, and anything above that, up to 100%, also requires FIPB approval. Sectors where 74% FDI limit is permitted includes airports, broadcasting, coal and lignite, credit information companies, mining of diamonds and precious stones, satellites, and the private sector banking. 51% FDI limit is permissible in multi-brand retailing and trading, and up to 49% is permissible in airlines, the civil aviation industry, defence, insurance, pension, and stock exchange. And up to 26% FDI is permitted in print media and FM radio. That's essentially a broad snapshot of the current scenario of the FDI regulations in relation to those particular sectors. If anyone has any questions on those in relation to a particular sector, I'd be delighted to potentially answer those at the end of the presentation. If you could perhaps move to the next slide, please. Thank you. So now, once we've established that FDI can be made into a particular sector, there are various routes of establishing your foothold in India. Essentially, the four most common are really the incorporation of an Indian company. You may, if you are a person of Indian origin or a non-resident Indian, you may invest in a partnership firm. Limited liability partnerships are also another form of structure which both foreigners and NRIs can invest into. And then also venture capital funds are also a common vehicle for equity investment. If we could perhaps move to the next slide, please. Thank you. So investing into India in 99% of cases that we come across inevitably involves incorporating a company. Corporate law and the Companies Act in India is very similar to the United Kingdom. Though in India we obviously have a sort of plethora of equity instruments which you see in transactions here. And if I could just sort of very quickly run you through the types of equity that we normally see when we're working on investment transactions here. We often see fully compulsory and mandatorily convertible preference shares, which provide a preference for fixed dividend, the repayment of capital, They may provide weighting on voting matters, but these two preferences, if they are to be provided amongst your shareholders, they must be incorporated in the constitutional documents of the company. We often come across fully compulsory and mandatorily convertible debentures. I would hesitate. Well, sorry, I would flag to you that these are debt instruments and not equity instruments, and therefore they do not give you voting rights. Often debentures here have fixed rates of interest. We also commonly see partly paid shares and warrants, and the pricing of these instruments is the key issue often. And often we spend a lot of time negotiating conversion formula to determine the value of those shares up front. We would flag here that at least 25% of the consideration needs to be paid in relation to that upfront valuation. We often deal with shares or debentures with optionality clauses such as put options and call options. I think the one thing that we'd like to flag here is that it is now essentially not possible to structure these with an assured return in mind. Essentially, these instruments, when you exit, the valuation of that exit will be determined at a fair market value at the time of exit. There are, in certain cases, minimum lock-in periods in relation to how long you hold those equity instruments from the date of allotment. Also, finally, I'd just like to quickly flag non-optional convertible preference shares or debentures. And again, these again are debt instruments, and they are regulated essentially by India's rules on external commercial borrowing. Thank you, Latoya. If we can move to the next slide, please. Thank you. In relation to holding share capital in India, the issue at some point may well come when you come to exit. You will need to consider to transfer. But in relation to issuing share capital, private Indian companies can only issue shares to persons resident outside India at a price not less than the fair valuation of those shares done by specified persons, who are normally people like accountants, as you'll obviously expect, and we call that fair market value. The conversion price or conversion formula for convertible equity instruments is often determined up front at the time of issue, and that conversion price cannot be lower than fair market value. When it comes to transferring your equity, persons resident outside of India can transfer to other persons resident in India. However, that transfer price shall not be more than fair market value. And again, persons resident in India can transfer equity by way of sale to a person outside of India, and that also must be done at a price no less than fair market value. Obviously, it goes without saying that one has to consider FDI caps, in particular in relation to Indian entities transferring shares to foreign entities, because the foreign entity cannot reach the FDI regulations. Thank you. If we can move to the next slide, please. A foreign entity may operate in India through an incorporated entity, through, for example, a liaison office, a branch office, or a project office, or a partnership. We'll speak a little bit about that in a moment. Or through an incorporated entity. Usually that's a wholly owned subsidiary, depending on the sector caps of FDI, or a joint venture, which again is determined by the FDI caps, but also more and more by business considerations and the utility of leveraging local knowledge in the Indian market. Thank you. If we can move to the next slide, please. So this organogram very neatly summarizes the way you can structure your Indian option your Indian option. You could obviously have a very indirect presence in India if you are simply just an importer, or you're licensing, or you're an agent. But you will need to have a direct presence in India if you are either manufacturing or providing goods or services. The best way to do that is obviously through an incorporated company. You can have a partial presence through a liaison office, a branch office, or a project office. And normally we see those structures where foreign entities have won a contract perhaps with an Indian entity to do something, and are exploring ways of trying to execute that. Thank you. If you can move to the next slide, please. In relation to unincorporated entities, if you decide to set up a branch office or a liaison office, you will need to get permission to do that. The entity that you need permission from depends upon whether the activity that you're planning in India falls under the automatic route or the approval route. If the activity that you're planning to do in India falls under the automatic route, you can get permission to open your branch office or your liaison office from the RBI. Usually that's very forthcoming. If you are investing into a sector that does not fall within the 100% automatic route, then you go through the government route. And that will invariably involve the FITB, and that permission needs to be sought from that entity. If, say, for example, you are a infrastructure company and you've won a contract in India to execute a particular project, what we often see in the first stages of that execution is the opening of a project office. Now, normally, a project office is granted generally if the entity can show that it's won a contract from an Indian entity. It's generally got to be funded directly by inward remittances from overseas, or otherwise funded by a bilateral or multilateral financing institution. It needs to be cleared by an appropriate authority that perhaps regulates that particular sector that the project is occurring in. And the company or entity in India awarding the contract, should have been granted a loan by a public financial institution or a bank in India for the project to pay for it. Those are the general criteria that we often see to establish a project office here. If any of those criteria are not there, then you have to go to the RBI to get permission to set up your project office. Thank you. If you can move to the next slide, please. In relation to unincorporated entities, if you're establishing a branch office, essentially we often see this with foreign entities who are engaged in manufacturing or trading activities. They tend to set up branch offices here. Basically what that obviously allows them to do is essentially all those things under the list of permissible activities in the right-hand column of the table. Basically, it allows them to export or import goods, professional consultancy services, services in IT, research work, promoting technical financial collaborations, representing generally the parent company in India, or acting as a buying or selling agent, rendering technical support, and also you often see foreign airlines and shipping companies opening up branch offices here. Essentially, the key point to note here is that retail trade and manufacturing is prohibited, and any profits which are made by the branch office are taxable in India before they are repatriable overseas. Two other key things that we need to think about in opening a branch office. One is that there needs to be a track record of profit for the preceding 5 financial years in the home or in the jurisdiction of incorporation of the foreign entity. and net worth needs to be no less than 100,000 US dollars. Thank you, Natoya. If you can move to the next slide, please. Opening a liaison office. Permission to set up a liaison office here is normally granted if the criteria we talked about in the earlier slide are ticked. Normally that permission is granted for a period of 3 years, though it may be extendable. If we say a few things about permissible activities, I think it's very important to flag that that liaison officers can only undertake liaison-type work in India. So therefore, it has to act as a channel of communication. It may promote export or import. It may promote technical collaboration. But the key thing is that it must not earn income. And furthermore, as a result of that, its expenses must be met by inward remittances of the overseas entity. In relation to opening a liaison office, you need to show a track record of profit for the 3 preceding financial years, and the net worth of the foreign entity needs to be no less than 50,000 USD. Thank you. If we can move to the next slide, please. Now, I wanted to say a few things about tax issues relating to unincorporated entities, because often what we see, in addition to establishing a branch office or a liaison office, is that we often see individuals who get seconded to India or sent to India and work in India. Now, you should be extremely careful about doing this, because what you don't want to do is basically trigger the criteria which would construe that the foreign entity has set up a permanent establishment in India. For the purposes of establishing or understanding a PE, essentially you need to look at your double taxation avoidance agreement. I suspect in relation to the audience here, that will mean between the UK and India. There it will have a definition of a PE and also other provisions relating to the taxation of particular activities. A permanent establishment is defined in the Indian Income Tax Act to include a fixed place of business through which the business of an enterprise is wholly or partly carried on. A PE is essentially viewed as an outcrop of the foreign entity in India. And in a relief for foreign entities, Article 7 of most standard form double taxation agreements stipulate that only the proportion of the profits that will be taxed in India are basically the profits that can be taxed in India will be those which are directly or indirectly attributable to the Indian permanent establishment. Hence, a PE which generates income with a business connection in India will be taxed in India. And if we move across to the next slide, please, we'll say a few more things about this. So in relation to establishing, to considering whether you've established a PE in India, you generally need to think about whether particular criteria trigger a fixed place PE, an agency PE, or a service PE. A geographic test in relation to a fixed PE, if the business is performed from an identifiable place in Indian territory, an office in India, then a PE will be established. If there's a test of right of usage, if the access and the usage of the place must be at the sole discretion and disposal of the foreign enterprise, then that would be deemed to trigger a place of business and also a permanent establishment. In relation to an agency PE, the binding test is one which is used to determine that. So if the agent can legally bind the foreign enterprise to perform a contract in India, then an agency PE will be deemed to exist. A dependency test is also used, which essentially, if contracts can be concluded on behalf of the foreign entity, or orders can be secured almost wholly for the foreign enterprise, and stock and goods maintained on behalf of the foreign enterprise in India, then a dependency test would be satisfied and the agency PE would be determined. Finally, there's an economic dependence test. If the entity in India earns a major portion of its income from activities accruing from or through the foreign enterprise, then an agency PE will be determined. Finally, in relation to a service PE, if employees of foreign enterprises furnish or perform services in India, it's highly likely that a PE will be established. Services covered under royalties or fees for technical services for a specified period of time are exempted from this category. Thank you, Natoya. If we can move to the next slide, please. Partnerships are obviously a form of unincorporated entity which can be established in India. So as I flagged earlier, it's normal. You have to be a person of Indian origin or a non-resident Indian to be able to contribute to partnerships here or be part of a partnership. It's very much very similar. Partnership law here in India is very similar in general to English partnership law. Essentially, it's not a separate legal entity, separate from its partners. In the absence of a partnership agreement, each partner has an equal right to participate in the management and control, profits and losses. Any partner of the firm can obviously bind the firm, and the firm is liable for that, and all liabilities incurred by any partner is a liability incurred on behalf of the firm. And as mentioned earlier, a non-resident Indian or a PIO resident outside India can invest in the capital of the firm or a proprietary concern in India on a non-repatriable basis. Thank you. If we can move to the next slide, please. Trusts are also occasionally seen in India as a way of doing business here. Again, trust law in India is broadly similar to what it is in the under English law. So a trust arises when one person holds legal title to property, but it's under an equitable duty to deal with that property for the benefit of someone else, a beneficiary. It's not a separate legal entity, and as such, trusts do not incur rights or liabilities, and the beneficiaries do not generally obtain rights against or incur liabilities to third parties because of the transactions or actions undertaken by the trustee in exercising those powers. If the trustee of a business trust is a corporation, then the participants may effectively limit their liability to the assets of the corporate trustee and the assets held by the corporation on trust for beneficiaries. And I think one final thing to flag in relation to trusts here in India is that a foreign resident may only be the beneficiary of a trust which is set up as a venture capital fund and only after receiving the prior consent of the Foreign Investment Promotion Board. Thank you. If you may move across to the next slide, please. Incorporated entities. Obviously, a private limited company is by far the most common way that foreign entities structure their businesses in India. Again, just like under English law, you will have a memorandum and articles of association. The articles will generally restrict the rights of transfer. The number of members in a private limited company has to be a minimum of 2 and a maximum of 200. And the articles of association must generally prohibit any invitation to the public to subscribe to securities of the company. Also, generally, the articles and memorandum, the things that you would generally see in an English law set of articles or an English law memorandum is generally similar to what you would expect to see in India and the constitutional documents of an Indian company. In relation to incorporating a company, it now takes around about 3 to 4 weeks, but that does, we find, tend to vary between state to state. And I think also one of that we would like to hear incorporating a company in India. It's very important that one of your directors has to be a resident in India. It doesn't necessarily mean that he has to be an Indian national, but he just has to be resident in India by virtue of spending at least 182 days in the previous financial year living in India. Thank you. If we can move to the next slide, please. Public limited companies, again, I mean, the broad distinction is that you're allowed to have far more members than a private limited company. And broadly, you've got to have a sort of company structured in order to do a list recognized exchange, broadly similar to the English law. One thing to note here is that you can be a listed company in India only has to maintain a public shareholding of at least 25% of its issued shares in the public market. Worth highlighting, I think companies need to, within 30 days of the establishment of a place of business in India, register itself with the registrar of companies as either a private or a public company. Thank you very much. If we can move to the next slide, please. Limited liability partnerships. We have an act now here in India which was passed in 2008. Again, very similar to what you would expect to see in England and Wales. It's essentially a way of a halfway house between a partnership and a limited liability company. So it permits essentially individual partners to shield from the liabilities created by other parties. What we would say about LLPs here is that they're essentially body corporates and exist as separate legal persons. Also, what we would also flag here is that LLPs, we see LLPs in relation to the provision of professional services in England and Wales. Here in India, the provision of professional services are by and large limited to Indian entities being able to provide those things. So, for example, firms here can currently be allowed to practice through a limited liability partnership structure. Although the LLP Act anticipates that professions will be able to adopt this structure, what has happened since that Act became binding in law is that professional bodies have by and large remained resistant to adopting rules and regulations to allow that particular profession, in particular law, to practice through a limited liability partnership structure. Thank you. If we can move on to the next slide, please. Joint ventures, again, are a very common way of entering the Indian market. Obviously, it's going to be essential in those sectors to allow FDI. But having said that, we're seeing more and more Indian companies do this to essentially leverage market advantage and strategic value that other players bring to the table. It's not so much now determined by legal necessity. And I think that's very much the same all over the world. But here in India, it's very, very useful to be able to, once you've focused on your particular sector in your market, and you know who the main players are in that, to a certain extent, it might be beneficial to consider through a JV model or indeed an acquisition, and we'll come on to that later. Obviously, entering into JVs with local partners essentially provide foreign firms with enhanced credibility, local contacts, market experience, and just it's very, very helpful to have an Indian entity or that the experience of an Indian entity in being able to essentially navigate this sort of complicated regulatory framework. That is something which I think is worth its weight in gold, depending upon the sector that you're investing in or you are going to be doing business in India. For foreign companies with existing presence in the Indian market, JVs obviously penetration into new geographical areas, also potentially give you the benefit of product line expansion and diversification, advantages in investment by diluting legal and financial liabilities between the partners, and that's obviously very beneficial at every stage of market entry and operational involvement. Two very common ways of structuring ventures here licensing lease or franchising JVs. And if we can move to the next slide, please. Licensing JVs, are very, very common amongst foreign companies, and essentially entail granting the domestic company the rights to produce and market a product in India under that foreign company's brand name. Obviously, we see this a lot in retail. In exchange for these rights, the foreign company typically receives a licensing fee, product and brand exposure in the Indian market at minimal cost. However, the nature of licensing the JV can limit control over the marketing and the image of the product in the Indian market. And JVs can sometimes lead to partners becoming future competitors after a venture concludes and the foreign company decides to directly sell its own product in the country. So therefore, in the context of your JV agreements, it's very, very important to think about things like non-compete and non-solicitation clauses. But that, I think, is not unique to India and is the same in all jurisdictions. Moving across, please, to the next slide. Thank you. Franchising JVs, again, are very, very popular. We see them, obviously, in particular in relation to food retail. They entail granting the Indian partners access to the company's brand name, marketing materials, and business plan. Exchange for becoming a franchisee, the Indian partner will essentially provide a percentage of turnover on a monthly or annual basis. And the franchising JV basically, rapid market entry and also entails relatively low startup costs and a low level of risk for the overseas company. The drawbacks of that include the need to build in mechanisms coordinating and controlling the activities of the franchisee, in addition to limited control over the business image and reputation. Thank you. Can you move across to the next slide? Finally, the other way of coming into the market is essentially to identify a target in India and either acquire its shares or acquire its assets, or essentially carve out a part of that business which you think is going to be valuable. In India, we have these categories of acquisition which are very similar to what happens in all markets. Slump sales, essentially, we often hear in India where we see it often where companies are struggling and they essentially want to carve out particular business things. Just makes it more attractive for the foreign. Asset transfers, again, also employed when liabilities expect a company to be acquired appear high or difficult to determine an estimate, and therefore, the buyer can essentially come and cherry pick assets to be transferred. A share acquisition, again, it's probably the fastest and most often used method to gain access to the Indian market, especially in relation to, obviously acquiring unlisted companies. It's actually, obviously, the benefit of that is that the operational losses of the company remain unchanged, sub course of things like control problems. Demergers and using the Indian market, the transfer or shares also being given shares in the transferee company and the resulting entity that arises from that. And that's essentially the four key modes of acquiring businesses here in India. Thank you. If we can move to the next slide, please. This slide essentially flags to you the pros and cons of some of those four different modes of making an action in India, acquiring assets in India. You'll see that in relation to those particular methods, you see a different time frame being taken to conclude those transactions. Obviously, we often find mergers and acquisitions are the most time-consuming because it often involves court sanctioning. I think what what often determines the way that you acquire a company here is potentially the stamp duty that you will pay in relation to the assets or the business being acquired, and the value of the business being acquired, or the shares which are being acquired. That often, requires a very careful preparation of impacts in each particular Indian state where the target company has operations. And then also the other key consideration is the tax implication that will arise, as a result of that particular transaction, and in particular for the seller. Thank you very much. And if you can just move to the next slide, please. In terms of acquisition and the process of acquisition here in India, whether it be through slump sale, asset acquisition, share purchase, or M&A, we broadly go through precisely the same loops and hurdles which you would go through in any other jurisdiction. So we would start off with a term sheet. Well, obviously, after commercial due diligence, we'd start off with a term sheet. Then we would do the legal and the financial due diligence. We would move across to the definitive agreements. Again, and the issues that we often negotiate here in India are very much the same as what we would expect to see in any other jurisdiction. One thing that we would flag here is that competition law is becoming increasingly important in relation to acquisitions here in India, in relation to a dominant position in the market. So that's something you may need to consider, though I think for most SMEs, obviously not be relevant. And again, I think one of the key things that we often see in M&A and market entry in India is cultural issues which require a great deal of sensitivity. Business, the way business is conducted here in India, and business strategy, the negotiating strategies are often very different, and sensitivity that you consider those particular issues will, I think, in the medium to long term, bear fruit of their weight in gold. And I think on that note, I'd like to have a presentation to the organisers. I'd be more than happy to take questions from you in relation to anything that we've spoken about today, or in fact anything else you might want to raise in relation to business in India and organ market entry. Thank you very much.
Thank you so much, dear Anne, for this excellent and detailed presentation. I certainly feel I've learned a lot, and I'm sure the attendees will agree with me. I'm sure there's going to be many more questions. We have a few at the moment, which we'll send across. So because we're running out of time, I'll kind of zip through the questions. One of them is, would setting up an outsourcing business be able to source government funding? The person hasn't really asked whether in the UK or India, not specified, but they've said that this would be for medical recruitment within the UK.
My intuitive response to that is I doubt it. Is that outsourcing is often driven by a cost competitive advantage, and where I've seen outsourcing happen before, obviously the outsourcer has essentially financed the setup of the outsourcing entity in India, simply because of the medium to long term cost gains that it will achieve through outsourcing into India. So as far as I'm aware, we don't see, certainly in India, any incentive, any funding incentive to outsourcing entities here. Though obviously the operation through particular structures in, for example, special economic zones give outsourcing entities a degree of benefits in relation to tax in particular. So while I'm not aware of any direct funding available, I think there are obviously tax concessions to operating outsourcing entities in SEZ zones.
Thank you. Yeah, I think that makes a lot of sense. I would agree. I haven't heard of Indian government kind of funding outsourcing operations My next question is quite a simple one, really. It's from me. What would you think for UK SMEs, which form most part of our audience? Is there a particular market entry route that you would recommend from all the ones that you have mentioned, or is that not really possible to say unless you know the kind of company?
I think it depends on what your business is, and if you're in the business of selling product, I would approach this through finding co-partners and distributing through India first to see whether your product has a market here. Once you start incorporating a company, once you actually set up shop here, if your business work out for a reason, the process of actually winding it up is quite a long and drawn out process. So, my advice here is to make sure that you've really done your due diligence with the demand for your product, and I would, as far as possible, think about offshore ways you can develop your business here in India, firstly, without having to plant your feet on the ground to a limited liability company. So if you're selling, goods and products, you can do that to a distributor here. The downside of distributors is that obviously transparency on what's going on the ground, and your business may require a degree of control as to what's going on the ground. But again, it depends on the sector and whether your business is contingent on control, or whether it's just a simple volume game of selling products.
Yeah, thank you very much, Ran. And I think, as you mentioned, one of the things that really stood out was how companies need to be very careful to make sure that they're not labeled as setting up a permanent establishment when they're not doing that. And you can fall under that so easily. So between companies like yourself and the UK IBC, we have the kind of necessary resources on ground to help companies through that particular difficulty. Another question, this will be the last question, I think, for the webinar. One of the key promises of the Modi government is to slash red tape and make it easier to do business in India. How successful do you think they've been in this endeavor, or do you see it as being mostly all talk? Would you say you've seen sort of specific examples of success that you can just tell us about?
I think it's a difficult question to answer. What I would say is that obviously we've seen, the World Bank, you may well be aware that the Ease of Doing Business World Bank survey for this year has seen India improve quite significantly from its previous entries. There is obviously an attempt to make business processing of running a business here as simple as possible. Those things, are underway and I think take time. I think the one thing that I would like to see happen most is to bring down the time it takes to incorporate a company. We still don't have a system here where in the UK you have shelf companies and you can essentially set up a company, within a day. That's something which we don't have in India, and I think will be an enormously positive step to be introduced into India. Though it remains to be seen to what extent that's on the agenda, and if to what extent and how quickly that could be pushed. But that's probably one of the biggest things that I would like to see change here in India. Incorporation it has blur. There's no doubt about that, but it's not. It's not comparable to the UK or Singapore or other very business pro-friendly jurisdictions.
Yeah, no, I agree. I think that they've made some improvements with this agenda in mind, but there's still a long way to go. But as long as they, continuing to kind of focus on that, then we just hope that change will come as quickly and definitively as possible. So thank you very much, Dhiran, for all your valuable insights and your time today. I hope this webinar was interesting and informative to everyone. If you have any feedback or comments about today's session or a session that you'd want to see us do in the future, please do feel free to get in touch. We'll be circulating the recording of the webinar to all the attendees. So if you, in case, I'm sure there's lots of things that you'd want to hear again. So thanks again for joining us, and thank you, dear Anne.
Not at all. Thank you, Natalia. Thank you, BC, and thank you, attendees. I'm delighted to have this opportunity to speak to you today.
Oh.